Will the market go up or down? Should you lock in or float? Find out this and more with Master of the Markets, hosted by Barry Habib of MBS Highway. Brought to you by Paramount Residential Mortgage Group.
Welcome to another edition of Master of the Markets. I'm Barry Habib at MBS Highway's created exclusively for NMP TV. It's brought to you by our good friends at PRMG who are working for your best interest. Man, the Fed doesn't care about inflation, and the market sure does. Bonds reacting to some inflationary fears. Testimony by Jerome Powell saying that basically, this is going to pass. We're not really worried about it. We're going to go steady as she goes. Listen, remember this. We haven't seen it in a long time, but when the Fed hikes rates, they fight inflation and the bond market doesn't. So if the Fed's not going to do its job, the bond market wants to do it for them. And that's why we've seen rates rise. There's a lot of inflationary fears. And I got to tell you something, we've got to be on the lookout for what's about to come. Before I do tell you about that, we did get a jobs report that was stronger than expected. Very interestingly, bond market initially did not like it, hit right up against 160 on the 10-year, fortunately held on and backed off. We break that, 167 is the next stop. And then, man, if we break that one, it's all the way up to 197. That's going to start to get a little ugly from where we were if that does happen. And there are a few catalysts in the works. Now, first off, next week, what we're going to be seeing is we're going to be seeing the Fed meeting. And if the Fed introduces something that they did in the past, about 7 years ago, called Operation Twist, where they sell short-term maturities and buy longer terms, bonds will like that. You'll get a rally. But last week, we saw the Fed Chairman Powell, in his testimony, not talk about that at all. And as part of that, the bond market did not like it. So be on guard for that. Now, this week, we have some important events. One is going to be the 10-year Treasury note auction. Let's see what the appetite is. That can really help things if there's a good response, but of late, they have not been biting on the 10-year, even at these elevated levels, and that could be problematic for us, so it's something that we need to be cautious about. In addition to that, the big number will be the inflation report. I don't think we'll get a scare on inflation. You want to look for core inflation that strips out food and energy. The last year-over-year reading was 1.4%. I don't think this makes it jump too much with this report, but it's about to get ugly. You see, what happens is you take the most recent 12 months. As you get to the new month, you kick out the old month. As we kick out the old month, what's about to happen is that the comparisons, you'll be getting a new month in and replacing a month that had very weak inflation. The next report that we're getting this week will replace February of 2020. The reading was 0.2%, so not so bad. But then, as you get into March, April, and May, the readings are 0, -0.4, -1/10. So that means if you replace them with 0.2 positive numbers, you're going to see inflation go from 1.4% to like 2.5%. And the bond market probably will not like that. Let's watch 160 on the 10-year. Let's be on guard. Get on MBS Highway so we can navigate you through this stuff. Focus on your purchases. MBS Highway can help you there too. Hope you guys have a great week ahead. Bye-bye.
Be sure to click on the link below for your free 30-day MBS Highway trial.